Welcome back to Microeconomics. I'm Keith Akucha. In this video, we're going to be talking about one of my favorite topics here, which is externalities. This is the case where when the actions, the choices of one individual party end up having external effects that either negatively or positively, although we're going to focus on the negatively, affect other economic agents. And in this case here, this often has big implications in terms of environmental economics, in terms of evaluating pollution, but this really has so many applications in terms of just interpersonal relation and so many aspects that we run into with our day-to-day life because there's so many things that we run into every single day where our actions result in consequences that we alone do not bear. And others have to face some of those costs or incur some of the costs of our decisions. And these externalities capture this model helps to explain and work out solutions to that problem. We'll ultimately take a look at this through two lenses. First, we'll take a look at a lens through how we could solve this just by ensuring property rights, by assigning property rights and ensuring that we have the legal framework for those property rights to be protected. We'll then take a look at a case where that's too complex, too complicated, or just beyond our ability, and ways that we can go and solve this problem by using taxation. So we'll take a look at both of those. Let's start off by taking a look at the problem itself as it stands and jump over and have a look at that. Well, let's get going. Okay, one of the classic cases of externalities that we see in the marketplace around us, and specifically we see this here on the South Vancouver Island as well, is the application of fertilizer on agriculture. Now, the problem is the farmers on their own, they want to produce more and more bushels of whatever they're producing, right? More and more tons of agricultural yield. However, to increase their agricultural yield, they often need to use more and more and more fertilizer. So, given the current price, they will go and figure out, okay, price, this is how many tons of agricultural output I'm going to need. And then subsidiary to that is going to be the amount of fertilizer that they use to get that outcome. The issue being, of course, is that this fertilizer, which is rich in nitrogen and phosphates and all these other chemicals which are good for plants, are often in excess of what the land needed. As a result, these fertilizers run off and they run off into our waterways, which then create algae blooms. And we see the effects of these algae blooms on our lakes in the fact that in the summers, we can't swim in them certain times of the year because of the algae blooms. We also see this effect in lost fishing because these algae blooms kill the fish. And so it has a direct negative economic impact on the fishermen. So the issue that we end up getting here is that the farmer, the individual farmer, is just going to take a look at the market price, equate the market price with their marginal cost of farming, and determine their. That's fun. Not what I'm looking for, though. Let's try that again. They're going to set their own quantity private based off of that. Then the issue being that every time they produce using their fertilizer, what we get as society, let's use green for this, is some, and I'm just going to presume it's a constant marginal external cost. And that is for every ton of agricultural yield that they have that they needed fertilizer for, this fertilizer causes an external cost to the rest of society, and the fact that we can't go swimming in the lakes during certain times, that all of the fish are dying, so we have less fishing output and yield. All of the other impacts that this has on the environment altogether, such that the marginal private cost plus this marginal external cost is going to yield for us all together. So marginal external plus marginal private is going to yield for us our marginal social cost. Okay. In this case here, this vertical distance between our social and our private cost curve, that is just equal to the marginal external cost. So that is our marginal social cost is just the marginal private plus the marginal external. And that is because this individual farmer who's facing their own individual marginal cost, they are a part of society. And so whatever costs they're facing are also social costs. However, the rest of us face these pollution costs, this runoff cost that we face in lost lake days, lost fishing yields, and all the rest. Altogether, the social cost of this external cost to society, can be quantified, can be determined by taking this private amount, carry it up, and we can look at it and get this area here. Let's use green for it. That whole shaded area there is the extra social cost that is faced due to this level of production that is currently unaccounted for in our production process and thus entirely just externalized for society to pay. Specifically, every point where this social cost curve is above the price, we are producing way too much. From a societal viewpoint, right, where we're like, hey, what is our cost versus what is the price that we get from this, equating benefits and costs. From this social viewpoint, the ideal place to be would be right there where our price equals our marginal social cost. And we could say, if we drag that down, we could get our Q social. If we were to obtain Q social, how does this play out altogether? Well, if we were to obtain Q social, society, so all of the fishermen, all of the users of the lakes, the waterways, all of that, they would gain all of this area in the fact that we're no longer polluted. So all of this pollution would be gone if we move down to Q social. This is a gain in the reduction in pollution. Let's just make that a little bit transparent. There we go. So we gain that blue area as benefit to society. That is the gains if we were to reduce that pollution. However, by doing so, our current farmers, well, our farmers, our producers, they're no longer producing at Q private. That is, they're giving up a bunch of their producer surplus, the difference between what they were willing to pay and that price that they have to pay. They're giving up all of this area, and that's a cost for them. That's their reduction in surplus. So we have, if we were to do this, say, hey, we would rather less agriculture, less fertilizer be used, reduce this, society gains that entire trapezoid. However, the producers lose part of their producer surplus, which would be this area. In red, the difference between the price they were willing to accept and the price they do accept is their foregone profits. So for them, they are not so happy with this because the producers are worse off by decreasing their amount of production. Because keep in mind, at this price, they don't see all of these extra external costs. All the profit maximizing firm is doing is saying, given my personal costs of production at this price, this is my Q star. My marginal revenue equals marginal cost. However, from society's viewpoint, if we take in all of those external costs, all the extra effects that are affecting everybody in lost lake days, lost fishing yields, and all the rest, we're like, no, marginal revenue equals marginal cost is actually down here. And that is the distinction. Now, of course, Right now, we're saying the way to solve this is by putting property rights into effect. And there's two situations that we could have for property rights. We could either say that the farmers have the right to pollute, which, to be honest, is a bit of the way that we currently structure our agricultural situation, which is they have the right to farm and they have the right to grow their crops, whatever that might mean. As a result, they typically have this right to pollute. Alternatively, the other side is that you and I, the fishermen, everybody else, we have the right to a clean environment. Depending on who has the property right, we can then determine how do we get about to this solution? How do we get about to this outcome? Okay, let's start off by presuming that the farmers, in fact, have a right to pollute. Well, if the farmers have the right to pollute, they have the right to be at Q private. If we're saying this is too much fertilizer, this is too much pollution, this is creating additional problems to everybody else in society, then we need to, as society, compensate farmers, incentivize farmers to produce less. And the way we would do that is by providing them compensation for their lost profits that they would have earned at Q private. By providing them that compensation, that red area there, we can incentivize them to produce less, use less fertilizer, and as a result, they would be happy to be at Q social if they were made whole from this loss, such that they win. They're no worse off. But what you have to keep in mind is in this case, what we are doing is we are paying the polluters not to pollute. That is the other way to put it, is that if you have the right to pollute, this private level of output becomes our reservation option. It becomes our default option. In order to incentivize the farmers to produce and thus pollute less, you would need to compensate them for their lost profits. That is, you would need to pay them in order to actually cut their production by this amount or more. But alternatively, if we have the right to a clean environment, well, if we have the right to a clean environment, then the social option here becomes the reservation, the default choice. In this case here, to allow the agriculture producers to use more fertilizer and increase their production, they would need to compensate the fishermen, the swimmers, everybody else by more than what their costs are that society would end up facing for every additional unit. If the farmer was willing to compensate by more than what the cost society faces, then society would be better off by that boost in income versus the increased cost due to the pollution. In each case, what we see is that you would have a payment to the other party in order to infringe on their rights. In the case of the right to pollute, you would need to pay the polluter to stop polluting because you're infringing on their rights. Alternatively, if we have the right to a clean environment, you would need to pay the holders of that right, society, you would need to pay them in order to compensate them to infringe on their right to that clean environment. While this works great in theory, and while this works great in a very small basis where property rights are very easily defined and where you have actors who are relatively equal access to the justice system to enforce this, it works okay. The problem is when you have that asymmetric power between actors, between maybe polluters and the users of the environment or vice versa, such that you either cannot identify who the other actors are in society who face the external costs, so you cannot easily compensate them, or in the case where it's just they can't be identified at all and thus compensation is not possible. In these cases here, mind you, there's even the collective action problem where even if society could be identified, we have the free riders where people don't want to collectively organize because they could get that benefit even if others organize on their behalf. So, all that to say, this falls apart when we get to larger scales, when we cannot so easily identify society, we cannot so easily identify the individuals who bear the external cost. In that case, what we need is property rights alone. The legal system alone is not sufficient in order to solve this externality problem, to allow us to reduce our production to a socially optimal level. We need the government to step in, and the government can step in this sense here by imposing a tax, which has the effect of internalizing this external cost on the producer, makes the producer realize that this external cost is taking place, and makes the producer actually internalize it into their production decision and change how much they want to produce, given that they now have to pay for this pollution, for this external cost. And so let's evaluate that. In this case here, the private and social cost curves stay the same. We're just now going to introduce the market demand for this. Let's go take a look. Okay, so in this scenario, we're taking a look at, well, same idea, an externality, and with coal-powered electricity. So ultimately, our good that we are producing is electricity, which is gigawatt hours. However, hopefully you should be aware that, hey, for every ton of coal that we burn, we release some amount of greenhouse gases. These greenhouse gases, of course, are an economic bad. They're not a great thing. And so for every amount of greenhouse gigawatt hours that we produce, we are going to have some amount of pollution, tons of greenhouse gases attached to it. So we could create this kind of secondary axis, taking a look at the economic bad that's attached to our economic good. Now, of course, right now, the coal-powered electricity plant, the coal-powered power plant, they're going to take the current market price and they're going to say, okay, price to marginal cost gives us our market clearing price and our Q star. We get our competitive equilibrium. And really all they're doing is just equating their marginal private cost to their marginal private benefit. However, as we know, greenhouse gases have, of course, their own external cost to them, which are the external costs of increased climate change, global warming, the increased variability in weather, and all the negative spin-offs that come from that, from increased weather damage to rising seas, not to mention the increased particulate in the air, which causes increased instances of COPD and other environmental health problems. Okay, all of that to say, attached to each ton of greenhouse gases, there is an external cost. So that is, we could take a look at our marginal external cost, and let's say that altogether we get a social cost that looks like this. So there's our marginal social cost, which equals the marginal private cost plus the marginal external cost. Saying, hey, great, you are producing electricity. Electricity is great. We need electricity for so much of our modern lifestyle and economy. But hey, you know what? When you produce it using coal power, at this price, you have a lot more costs than really we get in benefits. We don't really have that equilibrium being held. We are facing far more costs to this production process than benefits. And that's problematic. Keep in mind, everything we do has costs. The costs are not the issue. The issue is if we have more costs than benefits received. And right now, Right now, that's the problem. Right now, we have benefits down here. This would be our marginal private benefit, also our marginal social benefit. However, up here, here is our cost. So we have costs far exceeding our benefits at this price point. At this price point, we would want our social costs to be down here. So we would want significantly less quantity being produced by coal power. Okay, so how can we go about fixing this? One of the ways that we can go about solving this is to say, hey, you coal-powered firm, start actually taking into account all of these external costs into your production process. Think about these when you are determining what your Q star is. The way we can do this is by putting a tax on the firm's private cost function. Ideally, the Pigouvian tax, if you were, would be set a tax equal to the marginal external cost. So if we set a tax per unit, that is a tax per gigawatt hour, equal to the cost per gigawatt hour, what we would get is right over top of this marginal social cost curve, a marginal private cost, let's back that up. Marginal private cost plus the tax. Based off of that, based off having a tax on this, the firm now witnesses their new taxed marginal private cost curve and says, well, this price doesn't cut it anymore. Now we have to deal with these new prices, and the market is going to witness this new tax line as this new price with the tax. So as a result of putting this tax in effect, our prices rise. Yes, the tax gets passed on to consumers, partly. At this new price point, with the new line altogether, our profit maximizing producers are going price to our new marginal cost. So price to marginal cost puts us right there. And then they're carrying that down and they're saying, okay, we will now produce Q social. And of course, attached to Q social is some lower levels of greenhouse gas emissions because they're producing less electricity based off of coal power. Great. So we've put this in. Now at this new higher tax, we have this point here at Q social. What's happening at Q social? Well, price tax over to our demand line. Well, that demand line is our marginal social benefit. So now the benefit we get from production of this amount of gigawatt hours is there. But hey, also right here is our marginal social cost. And so what we get is by putting this tax into effect, by reducing the quantities, by pushing up the price that we pay, we are able to equate the marginal social cost to the marginal social benefit, and we're able to get some optimal level of output and correspondingly an optimal level of pollution such that the cost of producing electricity this way is offset by the benefits we get from electricity being produced this way. Now, of course, what you might realize is that the tax altogether, the tax is this vertical distance between these two lines. Now, the amount that the price increased was not that vertical distance between the two lines. In fact, it increased by a bit less. The result is, although you and I, the consumer, will now pay price tax, the resulting impact is that the producer will also receive a little bit less. And if we carry that across, essentially what this is you and I pay price tax, Then the government collects this tax. That is the distance between price tax and the firm's minimum willingness to accept. And as a result, the producer receives price producer. The difference between the tax, the price you and I pay, and the price the producer receives, well, that difference, of course, is the tax per unit. What we witness is with respect to the initial price that existed in the competitive market before, the consumers pay some of this tax, the producers pay some of this tax, and that is they each pay part of it based off of, well, the relative elasticity of supply and demand, but that gives us their relative tax incidence. Eyeballing it, it looks like the consumers are facing a larger portion of it than the producers, so we would say that the consumers are facing the tax incidence. Altogether, though, by putting this into effect, we get to this allocatively efficient outcome such that we can maximize our welfare, our surplus all together. And let's take a look at that. How does this maximize our welfare? How does this maximize our surplus? And in doing so, we can actually see why this whole taxing pollution, aka a carbon tax, is so grossly unpopular despite actually fixing the problem. And let's evaluate that. So to take a look, what we have initially at our competitive equilibrium. Well, at our competitive equilibrium, let's use our tools here. Consumers were getting below their willingness to pay all the way up to the price they had to pay. So that blue triangle, that worked out to be our consumer surplus. Great, that's what they're getting. Let's change this. Let's get rid of the border. Okay. Similarly, producers on the other side were getting above their willingness to accept below the price they do accept. So for them, that was this area here. Using red, we're getting above our willingness to accept below the price we had to accept. So altogether, we have our consumer, we have our producer surplus. However, we have the problem. We have all this pollution, all of this extra cost that is being borne by just society in general. And so all of this extra cost, it shows up as this area here, as this trapezoid. Keep in mind, where is this on the graph altogether? Well, let's just use green. We have an external cost of this distance between the private and the social cost. So that distance there, and all over the Q private units. So altogether, we are getting this whole area as our external cost. This is what society, just on whole, has to pay due to us producing at this private optimal market clearing situation. And right now, nobody explicitly pays for this. This is just incurred by all of society on whole. Let's make that just a little bit more transparent. All of society on whole is paying this pollution cost, this external cost, but they're all paying it indirectly. So that is, consumers see that they're getting this benefit. Producers see that they're getting that benefit. But then we all end up paying more in insurance premiums due to increased volatility of storms. We all end up paying more in our air conditioning bills due to higher temperatures. We all end up paying more in property damage due to increased floods. We all end up paying more in increased health costs due to increasing prevalence of COPD and other health problems. So that is, we don't explicitly link it to this market, to us consuming coal electricity, but this external cost is being generated from this. So it's entirely just a negative. It's just entirely a bad thing to us. So that is, altogether, we get a deadweight loss, keeping in mind, right? Consumers, they get all of that. This bit here just cancels each other out. This bit here just cancels each other out. It just gets rid of that cost. But we do have this portion of our cost that's just entirely unaccounted for. This is entirely just our dead weight loss due to the pollution. And as a result, we're worse off for it. Okay, well, what if we put in the tax? What if we put in the tax? Well, if we do that, we then get this little bit of a different outcome. Under the tax, producers are going to be getting above their willingness to accept, below their price producer. So producers are now getting this triangle here. What I want you to see, they are clearly getting less surplus than they were before. So producers are not going to be happy with this. They are upset with this carbon tax because they feel like they're worse off. Well, not only do they feel like they're worse off, they are worse off. Their surplus has shrunk because of this tax. What about consumers? Let's switch to blue. Our consumers are getting below their willingness to pay, above this new tax price that they have to pay. And so again, what I want you to see is that our consumers are also worse off. They used to be getting all of that blue area as consumer surplus. They're now getting this smaller area as consumer surplus. So they're much less happy as well. So consumers lose, producers lose. They're not happy in this scenario at all because this has just been a loss for them. However, we've now introduced government. This introduction of government is going to be this area here. And let's use magenta for government. They're now collecting this amount of tax revenue from this carbon tax, which is ultimately just being used to compensate all of those extra costs that we were previously facing. It is compensating, it is covering all of those negative effects due to the pollution, the health costs, the flooding costs, the increased sea level rise, and our costs to build bigger and bigger dikes to keep the sea level out. All of this is being collected to offset that. The impact, what you may witness altogether, is we have a net change. The net change is, okay, how does society change? Well, okay, government wins, government's happy. How does society change? Well, all of this pollution cost is now gone. We don't have to worry about it anymore because we're not producing it. So this whole area is gone to us. However, society has also lost this. Society has also lost that. But what we witness is this entire rectangle being gone is a benefit. We're no longer paying this negative cost. However, we do have this minus and this minus. So we get this entire trapezoid as a positive. We get those two little ones as a negative. On whole, our social surplus has increased. On whole, society is better off by having this tax in place because we're no longer having all of this excess pollution. However, the cruel irony of it is, even though society is better off, producers look at their bottom line and they go, well, I feel worse off, so I don't like this tax. Consumers look at it and they go, I'm paying more. I don't like this. I don't like this tax. I feel worse off. They both look at it and they look at the government as the only winner and they go, wait a minute, this actually isn't a problem. You're just taking our money to pad your bank accounts, saying we're better off because of it, but really we only feel worse off. And again, that's because those external social costs are felt after the fact are felt implicitly in those increased other costs that we witness. We don't explicitly link it to this market. And so it's very difficult for us to feel as if this actually helps this scenario because our two main actors just feel worse off by a carbon tax being put in place. Let's work through a numerical example to see this. It helps to actually evaluate this welfare analysis and see how we are as a result of this. So let's go jump over and work through it again numerically. Okay, so let's suppose that we have a demand curve. That is, this is our marginal social benefit or our marginal private benefit, which is equal to 100 minus 2Q. Similarly, we have our supply curve. This would be our marginal private cost curve, which is just equal to 10 plus Q. We then have this constant external cost of 30. And we could say something like, hey, for every, maybe we're talking about pulp. So for every ton of pulp that we produce, we release 1 ton of greenhouse gases. And then we could go and link that, hey, the cost of a ton of greenhouse gases is $30 a ton. So because the pulp does a 1-for-1 release of greenhouse gases, the cost of greenhouse gases is 30, right? There's no necessary negative with producing pulp. Pulp isn't the problem. Pulp's a very valuable product that's used to make paper, wood fiber, products, all the rest. This is a really good thing. It's all of these nasty pollutants that create our problem. So let's take a look at how we would work through this. Let's create our supply and demand diagram. And of course, we just presume for simplicity that we have competitive equilibrium. So we start off. We have our dollars, we have our quantities, and we're talking about our good here. So quantities in terms of tons of pulp. We have for our demand, we have a vertical intercept of 100, and then downward sloping, we intersect somewhere down here. That is our horizontal intercept of 50. Now, keep in mind, kind of like what we did last time, we could say that we have this pollution axis, and that is, in this case here, our quantity in terms of tons of greenhouse gases. And whatever that works out to be. Well, hey, I can figure out if I'm producing 50 tons of pulp, that is going to be also 50 tons of greenhouse gases, because we said it's a 1-to-1 relationship. Okay, what about the supply side? Well, we said that our marginal private cost is 10 plus 2Q. So if that's 100, let's say roughly something like that is 10. And there we go. This is our marginal private cost. This was just a fully label, our marginal social benefit or our marginal private benefit. Starting off at our competitive equilibrium, this is where the firm just gets to ignore the fact that they are polluting. It's not their problem. We can figure out what our competitive equilibrium price of pulp is and how much pulp we are producing. The way we do that again is just equating marginal private cost to marginal private benefit. So we just equate our two formulas. So we would get 100 minus 2Q equals 10 plus Q. Go through our algebraic voodoo. We get 100 equals 10 plus 3Q. Move that 10 over to the other side. 90 equals 3Q, divide both sides by 3, and we get 30 equals Q. So there we go. 30 tons of pulp is how much we are making in competitive equilibrium. That means 1 ton of pulp is 1 ton of greenhouse gases. We are also producing 30 tons of greenhouse gases. Great. What is going to be the price of pulp in this competitive equilibrium? Well, we can take this quantity, substitute it back into either one of these equations. Shouldn't matter which one, and get the same price. So 100 minus 2 times Q 100 minus 2 times 30. 100 minus 60 is 40. There we go. Alternatively, what do we have? 10 plus q, so 10 plus 30 is also 40. There we go. We get our competitive equilibrium. Now, what is our initial consumer producer social surplus underneath this competitive equilibrium? Well, we could work out the consumer producer. We would need to know what our external cost is, our pollution cost, before we could do the social. But let's do the consumer producer to start. So to start us off, let's go get a triangle and we'll go blue for our consumer. Consumer surplus looking something like that, below our willingness to pay, above the price we have to pay. So starting off, our consumer surplus is just a triangle, 1/2 base. We have a base of 30 times height. We have a height of 100 minus 40. We have a height of 60 there. Result of that all together is going to be $900 worth of consumer surplus. Our producer surplus, well, our producer surplus is going to be 1/2. And again, just to visualize it first, perhaps, let's use red. Above our willingness to accept, below the price we have to accept. So that red triangle is our producer surplus. 1/2, again, base of 30. Height of, oh, I didn't write it down. This was our vertical intercept of our supply curve. So that's 10. So in this case here, that is 30. So in this case here, we're going to get $450 for our producer surplus. Now, you'd be forgiven if you, just as we typically have done, just go and say, hey, consumer plus producer equals social. But what we have to keep in mind is that we have a pollution cost. We have a cost of society of $30 for every ton of greenhouse gases released. So what do we have? We have a cost of $30 per ton. We have 30 tons being released altogether. So we have a total external cost, or a pollution cost, of $30 per ton times 30 tons. We have altogether a pollution cost of $900, meaning our social surplus altogether is only $450, because the pollution cost completely offsets the consumer surplus. Okay, maybe you could follow through and say, hey, total external cost, $30 per ton of greenhouse gases, 30 greenhouse gases being released. But where does this show up in our actual diagram? It's not explicitly there yet. Well, let's showcase that. Let's see where it is. To see this, what we need to do is we need to figure out what is our marginal social cost. And keep in mind, all that marginal social cost is the marginal private cost plus the marginal external. So what's our private cost? 10 plus Q plus our marginal external of 30. So altogether, what do we get? We get our new marginal social cost as 10 plus 30. We get 40 plus Q to be our new marginal social cost. I shouldn't say new. We hadn't had a marginal social cost before. So we get our marginal social cost to be 40 plus Q. Let's clean up and draw that. We'll use a yellow for that, doing my best to keep this a parallel line. What we can see is that we have our vertical intercept of 40, the old price point, and this is altogether our marginal social cost. Okay, where was our pollution in this case? That's why we were doing this. Well, our pollution is going to be the difference between the social cost and the private cost, all the way up to the quantity produced. That is going to be the size of our pollution that was unaccounted for in our cost of production. And that would give us this area here. This green area are $30 per unit all over 30 tons of greenhouse gases. That green trapezoid, that is going to be our total external cost. That is our pollution cost. And what we see is it completely dominates our diagram in this case here. Let's just fade it down a little bit so it's not so overwhelming. We'll still be able to see it, but it will just be there in the background. Okay, with that transparency set, let's now evaluate how we could solve this externality problem, how we could obtain a socially optimal level of production, and then attach to that socially optimal level of pulp production some optimal level of pollution. And of course, that's going to take place when the marginal social cost equals the marginal social benefit. So that's going to be right there. How do we get this? Where is it possible? How is it possible to get to that? Well, our solution is to get this private cost curve to shift up over top of the social cost curve. And the way that we can do this is by setting a tax. We can set a tax equal to that marginal external cost. If we set the tax equal to our marginal external cost, well, then this line perfectly overlies on top of our marginal social cost curve, and we can get a new market price that we would end up charging for this. But more importantly, we would get our corresponding quantity exchanged, which would be socially optimal. And so how do we go through that? Well, we go and we equate our new marginal social cost curve with our marginal social benefit curve, and we equate those two to solve for our socially optimal level of production. So let's go through doing that. I'm just going to clean up a little bit because I want to save some of this information. Okay, so I've rearranged. I put our surpluses over here on the left-hand side. We had our total consumer surplus calculated as 900, our producer as 450, our total external cost, that is our pollution cost at 900, and the social surplus altogether at 450. What we now want to do is compute our social equilibrium. So that is where the marginal social benefit equals the marginal social cost. Truthfully, we should probably write that because that's not how we're equating. It is actually equal to the marginal private cost plus the tax, which is, of course, I'm being a bit pedantic because we said that is one and the same as our marginal social cost. That's why we are able to, as a market, given market conditions and just market forces on their whole, allowing this to be a natural equilibrium. So as we go through and solve this, we just go through our standard algebraic voodoo. So we get 100 equals 40 plus 3q. Move that 40 over, we get 60 equals 3q. Divide both sides by 3, and we get, it's a little bit wrong. There we go. We get 20 equals q. So altogether, in this competitive equilibrium with the tax being put into effect, our quantity exchanged with the tax is now only 20 tons of pulp. So we reduce our pulp production because it's now taxed, and so we have a higher price. But big takeaway with it is that this also reduces our amount of pollution from 30 tons of greenhouse gases down to 20 tons of greenhouse gases. Because keep in mind, we said that it was 1 ton of greenhouse gases per ton of pulp produced. We need to figure out what our price is that we pay with this tax. And again, to do so, we would take this quantity and either put it back up into that marginal social benefit or back up into that price plus tax line. Doesn't matter which one we do. What we end up getting in both cases is a tax price of 60. So we see that, yes, the cost of our pulp has gone up by $20 a ton from 40 to 60. What I want you to keep in mind, though, is that we set a tax equal to that marginal external cost. So we set a tax equal to 30, and as a result, our price that we pay only went up by 20. What happened to the other $10 of this tax? Well, the other $10 of this tax is ultimately paid for by the, let's use the right tool, is ultimately paid for by the producer, and that is with them having a lower price. Their new price will fall down to 30, such that they receive $10 fewer. The difference, of course, between the price you and I pay and the price the producers receive is our tax, which would be that $30 per ton. In this case here, we see that the tax incidence, that is the tax burden, falls on the consumer. They are paying the majority of this tax. They're paying 20 out of the $30, where the producer is only paying 10 out of the $30. Okay, what does this do though for our welfare analysis? Who's better off? Who's worse off? Is society actually improved by putting this tax in effect? Well, let's clean up this calculation here so we have some room to work, and let's compute our new consumer, producer, social surplus, and throwing in our government now as well. So for fun, let's start off with the government because we were just talking about them. They are altogether collecting $30 per ton of pulp. So they're collecting $30 per ton all over these 20 tons that are produced all together. So we get our government tax revenue, and that's just that box there. So that's just base times height. That is a base of 20 times a height of 30. So altogether, that is $600 that the government is collecting in tax revenue. How's the consumer doing? Well, the consumer under this tax is now receiving below their willingness to pay, above the price they have to pay. So they're getting that blue triangle now, which is 1/2 base. They're only consuming 20 tons of pulp, so base of 20, height of 100 down to the price they pay of 60. So that is a height of 40. So altogether, consumers are getting a surplus of $400. Ooh, versus that 900 they used to get. Consumers are not happy with this. They have lost substantially. What about our producers? Well, let's switch to red. Our producers are getting above their willingness to accept, below the price they do accept. So that's that red triangle there. So our producers, they are getting 1/2. They're producing 20, so 1/2 20 times height of 30 down to 10. So that's a height of, 30 down to 10 is a height of 20. Altogether, then, our producers are getting $200 worth of surplus, 1/2 base times height, versus the 450 they used to get. The producers are quite upset with this as well. Their producer surplus has shrunk. But how are we doing as society? Well, we've now completely internalized this cost of pollution. It's not just out there as an additional cost to be unaccounted for. So we don't need to count the pollution cost in any way. It's already been counted for with the tax. So we get all together as our social surplus. We get 600 plus 400 is 1,000, plus 200 is 1,200 all together. Versus the 450 we used to get, we see that society is actually significantly better off with this tax in effect. significantly, society is winning. We are now capturing the costs of this tax. We are no longer having all of this excess pollution that was entirely unaccounted for. That has been gone, that is reduced. The pollution that is existing is now being taxed, is now getting a payment for those costs, and this tax can now be redistributed to actually deal with the costs of this pollution, to pay for those increased health costs for COPD, to pay to clean the environment, to mitigate the pollution and the effluent runoff into our waterways. All of this is now captured, it's now accounted for, and we can now pay for it explicitly rather than having this just be an implicit cost that everybody pays for down the road. As a result, society overall wins. Society is much better off through the imposition of this pollution tax, through this imposition of a carbon tax. And with it, we get our socially optimal level of production, and attached to it, the socially optimal level of pollution. And let me just talk about that for a second, because I've thrown it around, but I haven't really evaluated it. Often you ask people, hey, what would be the socially optimal level of pollution? And they go, zero. Zero pollution is socially optimal. Pollution is just bad. And I agree with you, pollution is bad. But I'd also have to ask you, do you consume pollution directly? Do you go and say, I would like a ton of greenhouse gases, please? No, you don't. Pollution is entirely just attached to our production process. So in order to get zero pollution, zero pollution would have to mean zero production. And zero production means we're not able to produce the things that we need to survive. So any production we have is going to have some pollution to it. We just need to account for those pollution costs versus the benefits we get from the production, from the consumption, and as a result, temper our production, temper our consumption to these new lower levels, such that we account for the costs of that pollution, such that the benefit we get from consumption is equal to the total cost, including that pollution cost of production. And in that way, we can find a socially optimal level of pollution, which would be attached to our socially optimal level of production. Hope that made sense to you. We have two different ways that we can solve these externalities. When we can easily identify the parties involved, when it's often just that two individual situation, the assigning of property rights is one way that we can do this, and just having a willful compensation or using the courts to petition for compensation for infringement on property rights is one way that we can solve this externality problem. When that is too convoluted, too complex, or collective action just makes it too difficult to do, we can solve the pollution problem by using a pollution tax, by using a carbon tax, and greatly increasing social welfare by doing so. Unfortunately, as we see, doing so is also hugely unpopular with both the consumers and the producers. Thus, this is politically unpopular, although highly efficient, the most efficient way that we could solve this problem. Being the highly and the most efficient way to solve this problem, it also means it's also the most cost-effective way to solve this problem. Given that the costs of climate change are estimated to be in the trillions of dollars, arguably we need to look at solving this in the most efficient, cost-effective way possible. That is a carbon tax, even though it would be politically unpopular. That's the problem. Of course, if you have any questions, any concerns with this video, please reach out. Please feel free to comment below, or of course, send me an email. Till next time.